Hey everybody, welcome to your next session. I am Nkeshi Alameen from the bottom, and it is my pleasure to introduce our next guest to you, and they will be talking all about business fundamentals. So join me in welcoming Eric, Terrence, and Adrian. Yay!
Hi, everyone. My name's Eric Franklin Amarante. I teach at the University of Tennessee College of Law, but I'm also a practicing attorney. Prior to getting into academia, I practiced for about 6 years. I've been in academia for, 12-ish years now, but I never stopped practicing. And we at UT offer free legal services to small businesses, nonprofits, entrepreneurs, and artists. So if you're ever interested, if you ever have any legal issues, please give me a ring, shoot me an email. I'm happy to chat with you about your particular needs. So I'm going to start this session talking about some of the considerations you should think about when you are starting a business in terms of what entity to choose. So I'm the lawyer, and I got to say that I might be the least important person at this session. Because while the lawyer has, there's certainly a lot of legal issues that come into play. The bigger issues that come into play are business considerations and tax considerations. However, that doesn't mean that I don't have anything to say. So I want to talk about a few things. I want to say the five main considerations that I tell my clients to think about when they're choosing what type of business entity to be. And when I say business entity, I mean LLC, corporation, S corp, benefit corporation, all of those. The five main considerations are your liability exposure, are the services and goods that you provide such that there's a risk of potential liability, and also along with those lines, what your risk tolerance is. And that's a personal decision for each entrepreneur to determine. So liability exposure and risk tolerance is one. Tax considerations is a close second, if not first. Your current partners or your current investors would be the third consideration. Fourth would be future partners. And finally, marketing and legitimacy. I'm going to talk about all five of those and then talk about some of the entities right after that. So in terms of liability exposure, most legal entities provide a liability shield, meaning that if someone is harmed by the business and they sue the business for the business assets, not you and your personal assets. And that's obviously very, very attractive. However, that's not the only way to get a liability shield, or liability protection, rather. You can also protect your liability through contract by having folks sign waivers or releases, or having indemnification provisions in your contracts that will cover your losses by the counterparty. And you can also, obviously, or maybe not obviously, mitigate your risk through insurance. And so many entrepreneurs that I meet with are able to control their liability through insurance and contracts such that they feel comfortable not forming an entity at all. And that, again, depends upon what your risk tolerance is and the potential for liability that your business presents. The second big consideration is tax considerations. Many entities have what's called pass-through taxation. Some have entity level taxation. Some allow you to divvy up profits and losses in particular ways, and others require you to go straight through. I'll talk about all those in just a second, and also leave Adrian time to talk about those as well, but that's the number two consideration. Three, thinking about your current partners and investors. Do you have to define governance rights in such a way to avoid future disputes, or is it just you? Is it just you by yourself and maybe governance doesn't matter, or maybe you have some silent partners? And in that case, you probably need something in play so that way you are, or the correct party is in control of when people are paid and how they are paid. Sorry, I lost my notes here. And all right, so also, in addition to current partners and investors, the way that your entity is going to be taxed will influence that. So on some entities, you're going to have pass-through taxation, which is great for some people, but there's also a question of phantom income, which again, we'll talk about in just a second, which can upset people. And finally, the identity of your investors and partners might impact what type of entity you choose. For example, certain entities will not allow certain people with immigration statuses, different immigration statuses, to be owners. Finally, you want to think about what your, or not finally, sorry, second to final, you want to think about your future partners. Some people consider the formation of your entity as part of a messaging to who you want your future partners to be. So that might mean you form a more formal looking entity before you are formal. So that way you might attract institutional investors because they'll come in and say, oh, look, they're already a C Corp. That's what we like, that type of thing. Also, the newest entity, the Benefit Corporation, is a signal to investors and to customers the type of people you want to be working with. So if you're a benefit corporation that is interested not only in making money, but also in the environment, then that might attract different investors. And on that point goes to my final issue, marketing and or legitimacy. A lot of clients that I work with are really interested in having INC at the end of their name. Well, the only way you can do that is if you have a C Corp or an S Corp. You can't do that with an LLC. I personally don't see any difference, but I recognize I'm a lawyer and I'm not a regular person. And I want to defer to the entrepreneurs as to whether or not they see value in that. And also the Benefit Corporation is a clear marketing legitimacy vehicle. So two things I didn't mention, which you might have noticed, is double taxation and administrative burden. And these are, I think, myths that most entrepreneurs think are the most important things that drive your entity choice. Double taxation is the notion that if you are choosing an entity that has entity level taxation, that's like the C Corp, then you have to pay corporation taxes as well as taxes when you give distributions. That is technically true. However, most startups don't have taxable income, as unfortunately a lot of you know. When you're just getting started out, you're not going to owe corporate taxes. And so that you can kind of set aside. And even when you do have taxable income, there are ways to control that by spending money or investing money in the company and in different ways. And you can work closely with your tax advisor to avoid that. So I don't view double taxation as a driver of choice. Similarly, administrative burden. A lot of folks say, I want to form an LLC because it's easier. Having a corporation is so complicated. Well, it's true that corporations have more rules and have more administrative requirements, but they are so easy to master. You can do it in an afternoon, and a lawyer and an accountant can set you up to meet all the administrative requirements of a corporation. It's such a low burden that I don't think it should ever drive the decision-making in terms of entity choice. So in my last couple minutes, I want to cover the main entities and then maybe tee up questions that you might have for the Q&A session. The first one's a sole proprietor. All of you were sole proprietors before you chose an entity. If you never chose an entity, you're a sole proprietor unless you have a partner. It's an automatic designation. There's no liability shield associated with it, but it is a default status. If you have a partner and you don't file anything with the state, then you're a general partnership. Again, it's a default status, it's automatic, and again, there's no liability shield. What's really upsetting about a general partnership is called joint and several liability, meaning that if your partner engages in activities that create liabilities for the partnership, you're on the hook for the entirety of that liability if your partner disappears. And so once I talk to clients, if they're on their own, then maybe I'll let them talk to me about being a sole proprietor. But once you bring someone else in, I think it's time to consider forming an entity. And the entity choices that most people consider are LLCs, C Corps, S Corps, or benefit corporations. S Corps and LLCs have pass-through taxation, meaning that the profits and losses that the entity incurs pass directly through to the shareholders or the owners. And therefore, if you made a lot of money or lost a amount of money, that's going to be reflected on your personal taxes. The only difference between LLCs and S Corps are S Corps have a limit on the number and type of shareholders. I mentioned immigration status before. You have to be a resident alien in order to be a shareholder, or you can be a U.S. citizen. You also have to be a human. You can't be an institutional investor unless you're a special entity like a trust or a charity. For LLCs, there's no limitation on the number of owners you have or the type of owners that you have, but some LLCs choose to make an S election, and I will let your tax advisor tell you whether or not that makes sense. But depending on the way your profits or losses are coming in, you may be able to find some tax savings there by being an LLC with an S election. Finally, or second to last, I know I'm going over, but I'll wrap up really quickly. C corporations, they have entity level taxation and more rigid hierarchy, but this is the preferred entity for institutional investors. traditionally, institutional investors invest in C Corps because they like the rigidity. They like that they can count on certain entity actions to be written down and things of that nature. And so some organizations, even before they have institutional investors, will form a C Corps in order to message to the world that that's the type of entity that they hope to be. And finally, in the time that I don't have, I'd like to talk about benefit corporations, which is basically a corporation with, in addition to its profit motive, a nonprofit motive. And the idea is that this will theoretically prevent companies from having shareholder lawsuits. If you have a very greedy shareholder saying, hey, stop spending money on planting trees, I want you to just take that money and give it to me because I'm the shareholder. If you're a benefit corporation, you have an extra reason to say, no, that's not how we run things. We're a benefit corporation. I think that's an overstated concern because you can do that with corporations, LLCs, and S Corps. But I do think that the benefit corporation is a good way to announce that what you care about is more than just shareholder wealth maximization, and it can serve as a marketing opportunity that we are a Tennessee benefit corporation and we are interested in more than just making money. Finally, I do want to say that there's a difference between a benefit corporation and a B Corp. B Corp is a designation that is given by a third party. Benefit corporation is an entity that you choose from the Secretary of State of Tennessee. Okay, I just threw a ton of information at you. I hope I raised some issues that you're thinking about, and I hope I can answer some questions in the Q&A, but I've already gone over, and I need to hand it over to Terrence. And then after Terrence will be Adrian, and then hopefully we'll have time for Q&A. Thank you.
Thank you so much, Eric, and good afternoon to everyone on this great sunny Sunday afternoon. My name is Terrence Carter. I am with the Knoxville Area Urban League. What I do there is economic and business development primarily. So we do an entrepreneurship training program that we operate. We also are a community development financial institution. What that simply means is that we can make loans to startups and existing businesses when traditional financing does not work, meaning the entrepreneur or the business owner cannot qualify for traditional financing. So we are more of a high risk, fill in the gap type of lender. I also do activities like you're participating in today, where we are partnering with different organizations that serve small business owners to help them basically get a better grasp and understanding of what their business should and shouldn't be doing in this space that we're operating in, particularly during COVID-19. So what I want to do in my time is to share with all of you guys sort of some of the things that we see with regard to small businesses in particular. And I'm going to frame this in such a way where sometimes it's things not to do and sometimes it's certainly things to do. One of the biggest things that we see, particularly with smaller businesses, one man, one woman show kind of operations, mom and pop is what we call them. They're not often always well prepared and thoroughly understand who their market and who their customers are. And we try to preach this at the Urban League. You truly have to know who your particular customers are. You have to know what their needs and what their problems are. And you also have to understand and know, where they are currently going to get the product and or service that you could plan to offer. And most importantly, your products or your services have to be truly aligned with your customers. We often have people that will think, if you will, that everybody is their customer. And that is simply not true. So we stress doing research on your competition, on your industry, understanding what's going on, how many people are there in your industry, how much money are they spending, and then your job as an entrepreneur is to figure out how you can do a better job at serving your target customers. So the other thing that we see often is people not understanding the true cost of operating their businesses. Sometimes that's in the startup phase, and when you're not covering all those costs, it comes back to hurt you. But more importantly, your ongoing costs in terms of operating day to day, week to week, month to month, year to year. Understanding what your fixed costs are, your variable costs, your break-even point, and not understanding these things sometimes will throw off your revenue projections and your expense projections. And we see people a lot of times going out of business because they didn't understand the true cost, and they either undervalued, underpriced their product or service, and then sometimes they did the opposite where they overpriced and overvalued their product or service. Let me switch to also, let's talk for a second. Cash flow is also one of those big deals where you have to understand how much money it literally takes you to operate on a day-to-day basis, how much you have to sell, how much you're going to incur in expenses each and every day. So as you're operating, you have enough cash on hand to operate efficiently and effectively to serve your customers and deliver a product or service in the most value, quality driven way that you possibly can. Some businesses are cyclical, meaning it's up and down. Some are seasonal. So understanding your market, there's not going to be money made every day, every week, every month, but to keep your expenses covered, that's when managing and timing of cash flow is critical to you as a business owner. So making sure you have enough money on hand and inventory, if you will, to serve your product, to serve your customers when you have peak season, and you're going to do the opposite when it's not peak season. When you're not selling a lot, you don't want to have a whole lot of inventory or product on hand if you're not selling it and if this is not your peak time for your business or your industry. Also, when it comes to your customers, we stress making sure that you deliver and craft your marketing message directly to that customer. A lot of times people try to market to everyone, and then as you do that, you typically miss your particular target customer, whether that be business to business or consumer to business. But understanding your customer, understanding how to deliver a marketing message that resonates with them. We always look, there's some products and services that are very similar. For example, Bose and Beats headsets, where if you look at their customers and you look how they market those headphones, they're targeting very specific types of customers. Beats seems to be more of an athletic, if you will, for example, and Bose, just that person who likes good quality music without a whole lot of noise in the background. Or if you think about Target and I won't say JCPenney, I'll say more Walmart. While they are both retailers, their customers are slightly different. And if you look at their marketing strategy and their branding, they're always focused on their particular market and their messages always resonate with them. I don't want to take all of the 10 minutes, but I just wanted to share those things with you because they seem to be what a lot of small businesses don't have a very good handle on. And that is absolutely required to be very successful as a small business owner and to grow your business. If you're already an existing business and you're trying to grow your business, then you want a growth plan for how you plan on doing that as well. It's not just simply deciding one day I want to change this or change that to grow my business. It actually has to be a very strategic, methodical process that you go through. I'll give some real examples without any names and those kind of things with confidentiality, but we have some businesses that are small that grow too fast, meaning they got a lot of customers, but they don't have everything that they need to serve those customers. So they don't have enough capacity or bandwidth. And ultimately what happens is you frustrate the customer because you can't deliver what they need, when they need it, how they want it. And they in turn go to your competitor. And speaking of competitors, make sure you have a thorough knowledge and understanding who your competition is. We hear a lot of times people saying, well, I don't have any competition. Well, unless you're bringing something to the market that just does not exist and it's a new invention, that may not be true. But in most cases, that is not the case. There's always either direct or indirect competition. And when you are not aware of those competitors, that ends up having an adverse effect on your business because you're not focused on them. But trust and believe, they are certainly focused on you because you're both trying to compete for the business of the same customers. So with that said, I'm going to pass it off to Adrienne, and she's going to pick up on the tax part of your business in terms of what you should and shouldn't be doing. And Alex, if you'll switch her over, I am going to be seeing everybody in the chat room for Q&A, and I look forward to answering any questions I can. And if I don't have the answers, I certainly try to get them for you. But thanks for being here. Appreciate your appreciation. And every time you have an opportunity, take advantage of these moments where you have a lot of people with a lot of skills and talents that are willing to spend Sunday and Saturday here to help you. Have a good rest of the weekend and look forward to the Q&A.
Hi there. My name is Adrienne Webster, and I own an accounting firm here in Knoxville. Have 8 employees. We offer full-service bookkeeping, sales tax, payroll, accounts payable, receivables, and we also file state and federal income tax returns for individuals, for businesses, LLCs, corporations. I guess I want to start with following up with what Eric had mentioned, that there are federal designations for your business, and then there are state designations. So if it's just you and you haven't filed any paperwork with the state of Tennessee or any other state, you're a sole proprietor. You have to pay self-employment tax, and but you aren't required to file any other tax forms. So you can file your business tax return attached to your personal tax return every year. If there's more than one of you, like he said, you're a general partnership, and a general partnership is just 2 or more self-employed people subject to the same taxes. The only difference with a general partnership is that you are required to file a separate federal income tax return. But then the business itself doesn't pay any tax. All of the income or the profit or loss flows through to the owners on their personal tax returns. So beyond that, you can add state designations, an LLC, an S Corp, a C Corp, and depending on which one you choose, depends on how you're going to be taxed with the state. I think, well, let's talk about self-employment tax first. This is the thing that nobody wants to talk about. Self-employment tax is your Social Security and your Medicare, 15%. So when you work for someone else and you're getting a paycheck, your employer is withholding 7.5% of what you make that covers your Social Security and Medicare, and then they're also contributing the other 7.5% to your Social Security and Medicare. When you're self-employed, if you're a sole proprietor or a partner, you are responsible for paying the entire 15%. So if you whatever profit your business makes, this is a big misconception. If you're a sole proprietor and your business profits $10,000, you're going to have to pay that 15% self-employment tax on that $10,000. It doesn't matter if you took that $10,000 out of your business or not. If you didn't pay yourself a penny, if your business profited $10,000, you've got to pay self-employment tax of 15% on that $10,000. The same thing for a partnership. If you're a partnership and there are 2 of you and the business makes $10,000, but neither one of you took any money out of the business, you both are responsible for paying 15% self-employment tax on $5,000 each, because you're 50-50 partners. That self-employment tax is in addition to your federal income tax. So whatever federal income tax bracket you fall into, let's say because you've got investments or your spouse has a W-2 job, if you fall in the 15% federal income tax bracket, then that means on your self-employment earnings, you're going to be paying 30% tax to the federal government, because you're going to be paying 15% self-employment tax plus your 15% federal income tax. So that's the basics of federal income tax. Now let's say that you decide to add the LLC designation. Well, if it's just you and you're going from a sole proprietor to a single member LLC, federally you're taxed the exact same. Likewise, if there is more than one of you and you form a multi-member LLC, federally you're taxed the same as a partnership. The additional tax is paid to the state. So LLCs are required to file a franchise and excise return with the state of Tennessee every year. Am I running out of time? Yeah. LLCs have to file a franchise and excise tax return with the state of Tennessee. And what that is a minimum $100 for franchise tax. Your franchise tax is based on your net worth, so your assets minus your liabilities. Or if you don't have any assets, the value of any property that you rent as an asset. And people call it the rent tax. So let's say that you don't own any equipment or vehicles, but you pay office rent. So if you pay $1,000 a month in rent for your office space, that's $12,000 a year. Then what the state does is multiply that 12,000 by a factor of 8, and I'm not exactly sure why. So that puts you at 96,000 for your net worth. Then you're going to end up paying 0.25% franchise tax on that amount. So in $1,000 a month, that's about $200 a year in franchise tax. Excise tax. Well, likewise, so let's say instead of paying rent, let's say you bought your building in your LLC, and your building, you paid $100,000 for your building, then you're going to pay that same 0.25% franchise tax, which is $250 a year to the state for franchise tax. Excise tax is based on your net income. And this is where LLCs and S corps are taxed a little differently with the state. So if you are a multi-member LLC, most likely all of your income is going to be subject to federal self-employment tax. And the state of Tennessee has decided that if your income is subject to federal self-employment tax, then you don't have to pay excise tax on it. However, if you're an S corp, your net profit is not subject to federal self-employment tax. Therefore, the state is going to tax you 6.5% on the net earnings of your S corp. What else am I missing? All right, so that was federal income tax, self-employment tax, how franchise and excise tax works. Federally, we can talk about the difference between LLCs and S corps. So, like I said before, as a LLC member, whether you're a single member or a multi-member, all the profit of the business flows through to your personal tax return. So if the business profits $10,000, then the owners are responsible for paying that self-employment tax of 15% plus whatever their federal income tax rate is on the net profit of their business. It matters a little less how much money they take out of the business or pay themselves. As an S corp, instead of paying self-employment tax, you are required to treat yourself as an employee of the company. So instead of paying yourself, instead of paying that self-employment tax, you're getting a paycheck. So it's still 15%. The difference is that you're having 7.5% withheld from your paycheck and the company. So if you're the only shareholder in the S corp, you're still paying 15% self-employment tax. It's just on paper, it looks like you are paying 7.5%, and then the company is paying 7.5%. That's a quick, I feel like I was talking really fast, breakdown of business entity taxation. So I think we can go to the Q&A section now, which is my favorite part. Bring on the questions. Or if there aren't any questions, I can keep rambling. Happy to do that always.
While we're waiting for questions to come in, there's a lot of really detailed information here, and I think the real takeaway is that there's no kind of mechanical roadmap where you can just go like, I have business A, therefore follow these steps, and bang, I should be an LLC. There's just so many different things that go into play there, and that's really kind of the takeaway here.
Yeah, I think most often I get clients that come in who have formed LLCs or formed S corps because their uncle told them that they should do that. By the time they come in to consult with me, they're so far behind in their filings, or they don't understand the tax consequence of what they've done. So I think usually when people contact me and ask me what type of entity they should be, I, of course, tell them to speak to their attorney to talk about liability protection. But what I try to do is explain to them, if you want to be an LLC, it's going to cost you this much. If you want to be an S corp, you have to follow, you're going to pay this much, and you have to follow these sets of rules, because I think Eric could back me up on this one. Oftentimes people form LLCs or S corps for that liability protection, but then they don't act like LLCs or they don't act like S corps.
Right.
And then they don't end up having that protection that they're paying the tax on. So
Right.
I think it's important to understand how to act like whatever business entity you pick.
Right.
Yeah.
I agree with you. And so sole proprietorships act like, unfortunately, when they are not LLCs and S corps, and it's a whole different animal, not just in terms of how much you're going to be taxed, but it's certainly how you are operating your business. And the smaller you are, it just seems like you're trying to do so much, you are not focused on those critically important things. And I'll say this, it seems like this COVID situation caught a lot of people in that situation truly, really off guard. And unfortunately, they weren't able to take advantage of those benefits for payroll protection and the loans, that kind of thing, for that reason exactly.
Absolutely. All of a sudden, we've got a bunch of questions. Is there a preferred strategy to prevent phantom income?
For what?
Phantom income. I think that I think the answer to that is no. I mean, every business operates so differently, and every individual operates so differently, that I think that is a question that you really have to work with your tax advisor to answer.
Yeah, and can I just say that there's also there's a silver lining to phantom income, right? So the idea, as Adrian very clearly stated, was the profits of the business are going to be imputed to you even if you didn't actually receive those dollars, which sounds awful and scary. But the flip side of that is that you get the losses as well. And so especially as you're like building up, and if your company is experiencing business losses, that could be a way to really counter your personal tax income as well. Which is why I kind of started my whole thing by saying I think entity choice selection is really a tax decision, with like a sprinkling of law in there.
Oh, also the plus side too. So back to the sole proprietor LLC member who made $10,000 and is paying tax in 2019, for example, on that $10,000 that they never took out of the business in 2020. When they take that money out of the business, they're not paying tax on it again. So that's the, I don't want to say benefit, but I think that's important to understand, is that you're only taxed once on your self-employment income. Do you have to pay self-employment tax if your yearly profit is too low for federal income tax? Yes. That's a good question. For federal income tax purposes, right, you get your adjusted gross income, and then you get your standard deduction that comes off of that, and then that's the amount of money that you're taxed on. And the standard deduction is around $12,500 right now. So if you only made $10,000, you would not have to pay any federal income tax on that money. However, you still have to pay the 15% self-employment tax on that money, which confuses a lot of people. When they go out on their own in their first year, they are living off savings, or their parents are helping them, and they only make $10,000, and then I tell them, well, you owe $1,500. It's a bit of a shock, but the threshold for having to pay self-employment tax is $600.
So the next,
as someone starting out, how soon in the process should I think of setting up an LLC or S corp? I don't think it's ever too soon to start investigating that question. I mean, I think again, so much of it depends on what type of business, what it is you're doing, what your risk is. Eric can probably talk more about that, but it's never. I think as attorneys and accountants, we would always prefer that people come to us early on so that they know what to expect versus 2 years from now and everything's a big
Yeah, and just to piggyback on that, absolutely, it's never too early to think about it and to know what the process is going to be, and then in your own mind, looking at your personal income and your projected income for your business, thinking about when it makes the most sense for you to invest the time and money into forming that entity. And so I'll often have clients where I'm thinking like, oh my goodness, if we don't form an entity right now, I'm going to be really worried about you, right? But more often than not, they're in the stage that Terrence was describing, where you're still trying to figure out who your customers are, whether or not your service or good is going to get any traction. And it doesn't necessarily make sense to spend a lot of money and energy in setting up your business if you don't even know your business is going to be around in a month. And so, again, it's an individual question, but to answer your question literally, it's never just going to think about it and just know what the pros and cons are, what the costs are, and then identify, preferably in something that looks like a business plan, when you want to pull that trigger.
I think the next one is, what is a recommended business platform to keep accounting for a small business? QuickBooks is the go-to. That's what I use. I think QuickBooks can often be overwhelming for people just starting out. It's a very robust accounting software. There are some other cheaper and less robust softwares. FreshBooks is one, Wave is one, Xero. But the most important, this is my soapbox, is the most important thing when you're starting out is just track it somehow. Just track it somehow. I mean, if you're just starting out and you're just thinking about it, oftentimes I'll tell people to just go open up a separate bank account. It can be a personal account, that's fine, but put $1,000 in there and then run all of those startup costs through that one bank account. So you've got one place where you can go and look for all of those transactions. Because you'll forget that you paid $300 for a consult here, and you'll forget that you paid $100 to do some market research over here. Is just track it. You can track it through a bank account like that. You can track it in Excel, in a notebook. The most important thing is that you're tracking it, but I certainly wouldn't recommend, if you're just starting out, to just hit the ground running with something like QuickBooks, which is, kind of has the market on accounting software, because it'll overwhelm you.
And there's an added benefit to what Adrian just described, which I loved. Something that both Terrence and Adrian talked about right before the Q&A started was the potential for losing your liability shield. And the way you lose your liability shield is if you don't act like an LLC, even though you're filed as an LLC, or you don't act like a corporation, even though you're a corporation. And what happens is a court will look at, let's imagine something bad happens, someone sues you, and they want to come after your personal assets. And you're like, no, not my personal assets. I've got a corporation. That's the whole point, right? And a court might say, well, you had a corporation, but you didn't look like you were using a corporation. You were using the same funds for your personal account and for your business account. And as such, we can't tell the difference. And so we're going to let this harmed plaintiff reach your personal assets, which is obviously defeats the whole purpose of the liability shield. And so what Adrian just described is a way for you to get used to separating it. So even though you're a sole proprietor in the case that Adrian just described, you have this separate bank account, and you're learning that, okay, I have my personal bank account and I have the business bank account, and it's really, really important to keep them separate once you start a business entity.
And to keep things separate, like that's the easiest way to, in Eric's example, for the court to say, well, we can't tell what entity you're acting like, is you're paying your personal mortgage out of your business account, and you're getting your car repaired out of your business account, and you're buying your groceries. It's really and that applies to an LLC or an S corp, or or a C corp, the best thing you can do is keep all of those expenses
And let me just add to that. Even if you're a sole proprietor, if you're doing business, create a business account, period, so you can track business expenses compared to personal expenses. When you start using one account to cover all your expenses, you will soon be in trouble, and very quickly in trouble.
Absolutely. Yeah. Thank you. I didn't mean to suggest otherwise. Thank you, Terrence. I think the next question is, as a new online shop starting as a sole proprietor, is that a solid way to start? I think it depends on what you're selling, but generally speaking, well, first of all, if you have a website and you're selling something, you're already a sole proprietor. So you don't get to choose not to be. It just happens, right? You might be a general partnership if you have anybody else who's involved in the business with you and you're working together. At that point, I'd say worried. But if it's just you and you're starting up a business and you're selling goods, but the goods are not, say, dangerous, or it's not something that people consume that someone can get sick and sue you on. These are the types of things that I look into, whether or not there's a risk there. And I would say if the risk is low and you can manage it through insurance, or you are comfortable self-insuring it, I think a sole proprietorship is a great way to go. If the risk is high, if you were a restaurant, for example, and you had people coming into your business and they were consuming food that you made, you'd have a really hard time convincing me that there's no liability there, there's no potential risk. But if you're selling goods or artwork or something along those lines, I think the risk is relatively low, and I feel comfortable once talking to the client, making sure that you look into insurance and the different ways of mitigating your risk. I feel like that's a reasonably good way to go.
Agreed.
Certainly low overhead for sure.
Okay. As an LLC, if you pay self-employment tax, then you don't have to pay excise tax. That is correct. So, as an LLC, if the nature of your income is subject to self-employment tax, which it's probably easier to give you examples of income that is not subject to self-employment tax. Any sort of passive income, so rental property, if you have a rental house or own an apartment building and you form an LLC to protect that building, you do not have to pay self-employment tax. You only have to pay federal income tax on that income. So therefore, on the excise tax side with the state of Tennessee, you would be subject to the 6.5% excise tax. But if you're an accountant who's an LLC and all of your income is subject to self-employment tax, you would not have to pay excise tax on that. Everyone is liable for franchise tax, which was the tax on your net worth and your assets and your rent that you pay. That's the same for an LLC or an S corp, but the excise tax side only applies if you're not paying self-employment income to the federal government. It's confusing because it's called franchise and excise tax, and people are always, they say, well, I'm not a franchise, I shouldn't have to pay franchise tax, or excise taxes for tires and beer, and I shouldn't have to pay it. But the state of Tennessee means it in completely different ways for LLC and S corp purposes. Hopefully, let me know if that didn't answer your question.
So how do you know if insurance will protect you or if you need an LLC? That's a great question. And unfortunately, normally I tell you to read your insurance contract, but we all know how impossible that is. What I usually do is find an insurance agent that I can trust, what I tell my clients to find an insurance agent that you can trust that will give you not an off-the-shelf insurance policy, but rather talk to you about what your business is, talk to you about what your specific risks are, and then craft a policy that will cover what you need. There's also, if any of us have had the misfortune of needing to ask an insurance company to cover a cost, we know that can sometimes be difficult, right? And so you might want to, maybe you've had bad experiences with insurance companies and you just don't want to deal with them at all, and that might be a reason why you want to rely more on the liability shield and on contractual restrictions. But unfortunately, there's no easy way to tell you whether or not your specific insurance policy will cover it without reading the policy, looking at the limits, looking at the qualifications, and that's just kind of a painful experience. But that's something, frankly, that we do at the clinic. If that's something you need help with, if you want us to review your policy, so we're happy to do that. I think that question actually ties into this next question pretty well. Are we over time? Do we have until 2? I think we have until 2. Okay. How can an individual small business startup protect itself and its owners from a litigious environment? Now, we're often lazy with our language, and we say things like, oh, you have a liability shield, therefore your personal assets are protected if you're sued. Or we'll say, if you have a good contract in place, then a client won't have a claim against you if something goes south, right? Now, that is technically true, but they can still sue you. Anybody can sue you for anything. I could sue you right now because you hurt my feelings, Judy, for asking this question. Now, are you going to win? Of course you're going to win. That's a dumb lawsuit. But that doesn't mean you don't have to show up to court and say, hey, judge, throw out this dumb lawsuit. And unfortunately, that costs money, right? We're just describing living in America, unfortunately. I think that the best way to avoid litigiousness is to be as transparent and fair with your clients as possible. So if you sense a risk of a client coming in who looks like or seems like the type of person that is going to cause trouble, be very, very clear about what your policies are and say, okay, look, this is as is. I'm selling you this good. I'm not making any warranties to it. If you take it home and it doesn't work, that's on you. And that's what this contract says. Making sure that when a client signs a release, they understand what the release is, and they're not just signing a release and then everybody's secret about it. But you're so that way, for example, if you're doing an outdoor tours company or something and you have people on bicycles and you're like, well, that sounds dangerous. People could fall and skin their knee. You tell them, you're signing a document right now that says you promise not to sue me if you fall down and skin your knee. And then even though we live in America and this is probably the most litigious place on the planet Earth, most people will know, well, I'd like to sue, but I did say that I wasn't going to sue. And that's a good way to avoid frivolous litigation. But we need to caveat all that with people can and will sue for anything, unfortunately.
And Eric, can I just add to that? Because we've been talking a lot on the delivery of the product or service side, but just from an internal operational structure side, if you have partners and multiple partners, as you're talking to your insurance carriers and brokers, have a conversation about that too, because those can be some knockdown, drag out fights when you're having to sue your partner or partners when it comes to the business that you all jointly own.
I could, yeah, amen. I can't. Something I often tell my clients, if there's more than one of them, is that you should consider this to be a marriage. We're all really happy right now when we're getting married, hopefully. Right. But we all know that about half of all marriages end in divorces. And I don't know the numbers, but I suspect many, 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 many more partnerships end in the equivalent of divorce. And so you should plan for it when you're happy. When you can stand being in the room with this person, let's plan how we're going to end things. So very, very, very well taken, Terrence. Is there a 3-year limit of losing money where you revert to being a hobby and not a business? Oh, right. I defer to Adrian on this.
Yeah, that's a fun one. So what the hobby loss rules are about is basically the IRS has the right to come in if you continually show losses on your Schedule C, on your business tax return. The IRS has the ability to come in and say, hey, we don't actually think you're trying to make a profit. You are trying to avoid taxes because you have income from this other place. And they can question your income and expenses, and they can reclassify you as a hobby. There's not a specific formula. I think the best way, if that's something that you're worried about, the best thing to do is keep really good expense records. Make sure that all of your expenses are legitimate business expenses. The IRS wording is ordinary and necessary. If you're writing off $20,000 a year in overdraft fees because you're constantly bouncing checks in your business, that is not an ordinary or a necessary business expense. The IRS is going to take that one away, which could flip your loss into a profit. So that's a great question, and it is a gray area, and we definitely advise clients on the 3rd year of taking a a loss, especially if they're big losses.
And can I add one
Oh, sorry.
just in terms of losses, and this is where things really hurt people when it came to losses in their businesses and not having anything to show in terms of profit. People assume that they would be eligible for payroll protection money, but if you had a loss, the federal government is not going to give you any money if you didn't pay any taxes.
Exactly.
So it hurt a lot of people, and a lot of people structure their business so they can get a big tax return. Trade-off is when things like this happen and you can't take advantage of it.
Very true. Are we officially out of time?
We have 8 minutes.
8 minutes.
So there was a benefit corporation question, but it disappeared. I guess it was retracted. If you have a specific benefit corporation question, please come talk to me. I'm happy to chat about it. I've formed quite a few benefit corporations. So yeah, I'm happy to help out with that if that's something you're interested in.
Well, thank you all. Eric, Karen, thanks for presenting.
Thank you, guys. Appreciate you being on with me. Great job. And I will be reaching out to you all both because as we deal with a lot of startups, there are always legal issues and there are always accounting issues. And bookkeeping is a major issue that we try to stress to people on the front end. So maybe, Adrian, you can help us with that conversation with these individuals before they start doing some crazy stuff and not have anything set up to even track money before they start. It's like, I'm going to make this money, but I don't have no way to track it now.
Absolutely.
Excellent.
I appreciate it. Thanks. You guys have a great rest of the weekend.